and let's go. The recording has started, so this will be the lecture for chapter 2. Financial accounting. So very quick overview of what we talk about it. In order you to do accounting, obviously we have to follow rules. Accounting standards are the rules that are governing the accounting. They have two sets of financial standards. One is for international financial reporting standards. The other is the standards for the private enterprises, since we have two types of companies. Who is responsible for setting the standards? International financial reporting standards are set by International Accounting Standard Board. Canadian Accounting Standard Board is the one who governs the standards in Canada. There are a lot of concepts that are involved in the setting of the standards. So we have two types of concepts. So we have fundamental qualitative characteristics or concepts, and enhance qualitative characteristics. We're not going to talk about each of those because we're not going to go deep in the accounting, just mentioning which are the more important one in order you to understand the financial statements from different company. All the reports which are prepared for those companies has to follow those standards. Again, one of the standards are fundamental, so which are the equal for everybody else, the same fundamental principles and characteristics are followed by the preparers of the financial statements. The other one are enhancing qualitative characteristics, which also follow when the preparers of the financial statements issuing the financial statements. Going concern is one of the assumptions. Going concern means the company is going to keep working on the in foreseeable future. Foreseeable future, obviously some extended future from now. Cash versus accrual basis. We in accounting like to use accrual basis because it represents the events when they happened, not when the cash is realized. That's the major difference between the cash basis accounting and accrual basis accounting. In the cash basis accounting, only when the cash is exchanged, then that creates a transaction, or that creates an event for the accounting purposes, where in the accrual basis, we consider a transaction happen at the time when the goods are exchanged or event happen, not when the cash has been received or paid. Example for that would be the revenue recognition. We are recognizing the revenue based on the performance rather than realization. Accounting equation, as we already talked in the classroom, that's equal to asset, equal to liability and shareholders' equity. What that means is that available assets in every company or in your household, if you want to put it this way, either belongs to somebody else, either belongs to you. So for whatever you have, once you pay to the people that you owe, whatever is left is yours. And that's your call equity. Equity belongs to the shareholders. Now, what drives the equity? The equity is driven by the retained earnings, which is the income left in the company, or when the company to the normal operation where they're generating income, that increase the earnings. And when that income is distributed back to the shareholders in form of dividend, that reducing the retained earnings. Retained earnings basically means something that is kept in the company. Retain means keep. Earnings is the difference between revenue expenses, which is equal net income. So net income increase the retained earnings, the dividend declare decreasing the retained earnings, and that's how you get in the ending return earnings balance. The template approach is the very simple basic approach for you as a beginners to understand the accounting, which also always follow the simple model. Asset is equal to liability and equity. And now we're going to see under assets what kind of different categories assets you may have. As you can see here, you can have cash, accounts receivable, inventory, prepaid insurance, equipment, and land. Under liability, you have accounts payable, interest payable, bank loan payable. Every time when you see payable, that means it has to be paid. That means liability. And the equity, you have the common shares and retained earnings. At the very end is the revenue and expenses. One thing that I want you to understand, every time when the company generates revenue, that increasing retained earnings or shareholders' equity. Every time when the company incur expenses, that reducing the retained earnings or reducing the shareholders' equity. And the last thing is DD, that what you can see here is the DD. That DD, it means the dividend declared. Now every transaction, it has to affect two sides of the account, two accounts, sorry. It can affect one side of the equation only, can affect both sides of the equation, depending on transactions. Now we're going to start with the transactions, and I'm going to flipping back and forth with the Excel spreadsheet and the slides, so you can see how we're recording the transactions on the Excel spreadsheet that I have here. What I can do is, if you want to, do you want to work with me or you want to just watch and do nothing? Which one you prefer?
Sir, I want to work with you.
You want to work with me together? Okay.
Yes,
So for
sir.
that reason, give me just a second. And what I can do is I'm going to send you one email right away. And we can start working together. I'm going to go over this chart so you can see everything that has to be done. All right. This one, and I'm going to send you email in a second. All right, almost there. Let me see if how this will be the easiest way to send you email. There we go. Okay, I just sent you. Check your UCW email, please.
Yes, sir.
Okay, let's open that Excel spreadsheet and let's start working together then. Let me show you what you're going to see on the Excel spreadsheet. On that Excel spreadsheet, you're gonna see something like this should be what you're seeing, correct?
Yes.
On the
Yes, sir.
transaction 1 and 2 worksheet. On the first one is the retained earnings and what affects the retained earnings. Basic accounting equation, asset equal to liability and equity, and revenue expenses give you the net income. So if the net income is 100, expenses 80, obviously net income in the first period is 20. That 20 is going to increase the retained earnings, and let's pretend we declare the dividend. That reducing the retained earnings to 10. Next period, you generating more income, but you did giving the more dividend than the income plus the retained earning for the period, and that's how you wash out the retained earning to 0. That's what it says here. Basic accounting equation. And on the assets, you're going to have cash, accounts receivable, inventory. Under liability, you can have accounts payable, interest payable. Under equity, you're going to have a common shares or contributed capital. And retained earnings. Those are the very basic stuff. Here you can example for other payables, interest payable, a bank loan payable, long-term something payable, everything that's related to payable, it will be liability. And keep the equation in balance. Always know the liability plus equity is equal to the assets. So for that reason, equity is always the difference between the assets minus the liability. Now for the transactions, already pre-set up this chart. For you with the cash, accounts receivable, inventory, prepaid expenses, equipment, and land, which are under assets. As you can see, we can merge those one and we'll do it like this, and that will be, we can change the font if you want it like a more like a greenish kind of thing. And then the liability, we can, since the liability is something not very nice, we can put not that one. Sorry, we can put some font here on the liability to be that way. And the equity is those two, merge those cells, and we can put it in green. Some other color. Let's put this color, and there we go. We have a nice, beautiful, colorful chart. Now the only thing that left is the revenue expenses and dividend declared. In order to see this one on the same screen, we can reduce those cells, and now you can see everything on one place. Can you guys see my screen?
Yes,
Yes.
sir.
Yes,
Okay.
yes, sir.
So now what we have to do is go back to the slides and see what says on the slides. It's very simple. The process is very simple. From here, from the slides, what I'm gonna do, I'm gonna copy this, but I need you to have the slides open as well, so you can do exactly what I'm doing. So what I'm gonna do is, technically, I'm gonna copy these slides inside the slides, and then I'm gonna paste it inside the Excel spreadsheet. And that way we can work with the Excel spreadsheet by eliminating the slides. Already posted, the first one is already posted for you, so you don't have to do anything. So the first transaction is, we can name it here number transaction if you want, number 1. Transaction number 1, and that will be, can get rid of those zeros, we don't need zeros here. First transaction involve the common shares were issued for cash. So what that means is, somebody decide to open company. In order that company to operate, that company need assets. As we already established, the most liquid asset is the cash. So most likely whoever wants to open company, the first thing is to invest cash. For that cash, company issue common shares, which was given to the person who gave the cash. That most likely will be the owner. So the question is now, since we already know that the company is separate legal entity from the owner, that means the owner is not the company, company is not the owner. That means whatever owner gives to the company, that belongs to the company, doesn't belong to the owner, right? Even though it's your company, you're the one who opened the company. Whatever company has, that's not yours. It's a company's. Make sense? Because you're separate legal entity when you say corporation. For that reason, when you give the money to the company, company owes you money. Those are not your money, those are now company's money. So now, company, what the company is going to get? Company is going to get cash, 250,000. Now the question is, what the company is going to give, right? That's asset, obviously. That's asset. Company get cash, that's asset. No questions about it. But we have to keep the equation intact. So that means that we need something on the other side as well. What you can do here is you can highlight those rows and you can increase the font so it can become a little bit bigger, like stay with 14, let's say. And the company issue common shares. So now cash increase, give increase. So common shares also increase because was issued 250,000 common shares. And now we are in balance. Cash goes up with 250, equity goes with 250, liability. Any changes in liability? No. Liability stays the same. No changes in the liability. Make sense?
Yes, sir.
Okay. Let's see now the second journal entry. I already copy and pasted for you. The second transaction is now the company borrow money from the bank. What the company get? Well, obviously company gets cash. When you borrow from the bank, the only thing that you're getting is cash, $100,000 cash. But now we have to see what's happened on the other side, because again, we have to keep the equation in balance. Assets always have to be equal to liability plus equity. So let's see, did we issue shares? No, we didn't issue shares. But what we did, we borrow money from the bank. Do we have to pay those money back to the bank? Yes, we do.
Yeah.
So basically, that creates a liability for the company, $100,000, which has to be paid back for the bank as a bank loan payable. Now, at this point, if you want, what we can do, I don't know how many transactions are, but let's do this. Let's get the totals here. How much is the assets now? Automatically, now we have 350 assets, correct? And everything else is zero. On the other side, what we have? We have $100,000 bank loan and no other liabilities. And on the equity side, we have 250 common shares. No retained earnings at this point. Revenue, expenses, dividend, nothing here. It's not gonna let me do some because there's nothing here. Anyway, let's leave it the way it is. So what we can see is if we have to combine all those rows and put the formula here, that to be equal to of all the assets. So far I have $350,000 assets On the liability side, I have $100,000 liability, and on the equity side, I have $250,000. Am I in balance? Absolutely. 350 is equal to 100 plus 250. We are in balance. So now we can move to the next transaction. Make sense?
Yes, sir.
Awesome. We can highlight those numbers. So we can have those numbers highlighted. And after that line, we can get something like this to make it more fancy. And if you want, change the color here. Choose one color, and now it's more fancy stuff. So what I want you to do now at this point, after those two transactions and the adjustments that we made, click on the bottom of the worksheet, press Control on your keyboard, drag it to one side, and you duplicated the worksheet. The other thing is old-fashioned way, copy and paste. Is the copy, move copy, copy and paste it for some new worksheet. That will be the old-fashioned way. The easiest way is again, press Control, click on the worksheet, press Control, drag it on the left side. You're gonna create a new one. I don't need so many, so I'm gonna delete one and delete this one, and I'm gonna put here transactions 3 and transaction 4, and we can do transaction 3 and transaction 4 on the same worksheet. So now, in order to do that, I need to delete this slide, and then delete this slide. Now, I'm gonna stop sharing this Excel spreadsheet. I'm gonna move to the slides. So the first transaction was the company borrow, the owner of the company invested 200. That's asset cash increase with 250. Shareholders equity increase with 250. We already done that one. Next one is the company borrow $100,000 loan from the bank. Cash increase with $100,000. Liability bank loan payable increase with $100,000. So now let's see the transaction 3. Transaction 3 is we paid. So what you can do is once you click here, once you're on the slide, right? If you're somewhere on the slide, you can see there's no lines, nothing. But if you click inside, you're gonna see this frame. What you have to do, go on the corner of the frame and right-click copy. Once you do that, now you can move to the Excel spreadsheet. Right here. And what you can do is paste it as a picture. And you have it. Modify it to be something like that. And now we have it here. Now we can work on our Excel spreadsheet with the transaction number 3. So what's happened in this transaction number 3? Company paid 1,100 cash for January rent. What will be that now? That obviously will be expense. So what we did, we paid cash. Let's reduce our cash, because if we pay cash, that means we don't have cash. So our cash go down with $1,100. There's no liability because we pay the cash. Liability only creates when we haven't paid the cash. But since we pay the cash, there's no liability here. There's no equity here because nobody gives the money to invest. We're not paying everybody dividend. The only thing that happened is we're gonna have now expense. Which expense it's gonna reduce the owner's equity with negative $1,100. And we're done with this transaction. Now let's see the fourth one. What's going to happen with number 4? Again, I have to go back to the slides and see what's happened in the fourth transaction. In the fourth transaction, again, click on the transaction, on the frame, on the corner, copy the entire table. Let's call it table. And let's go back to the Excel spreadsheet. Paste it as a picture. Make it smaller. Feed it here on the top. And now we have the second transaction, the transaction number 4. Transaction number 4, what's happened is the company paid $65,000 to purchase equipment. So what's happened in that case? That's transaction number 4. In that case is company purchase equipment. So before we purchase the equipment, we have $65,000 cash. After we purchase the equipment, we have equipment which worth $65,000, and we don't have $65,000 cash because we pay for that equipment. So what we have? We have the equipment, $65,000. It's ours, but we pay for it. How we paid? Cash. So our cash goes down with $65,000. So the question is, are we in balance? Well, the $65,000 reduction in the cash give us $65,000 increase in equipment, which is we converted one asset to another asset. So basically, there's no change in the assets. Assets is 0. There's no liability. This transaction doesn't create a liability because we pay the cash right away, and doesn't increase or decrease the equity. So what we have to check on the bottom, are we in balance? We're not yet in balance because we need this one here. We need to get this one now here, and that will be equal to plus this cell here. And now we're going to be in balance. Again, the expenses is going to reduce the owner's equity. And now we're going to have on one side $348,000 assets. Of those assets, we have $283,900 cash, $65,000 equipment. We have $100,000 liability, which is bank loan that we have. And we have common shares for $150 and expenses for $1,100, which expenses reduce the equity. So our equity is only $248,900. That's what happened with the company, with the assets of the company after the first 4 transactions in the life of the company. Let's keep going and see what's going to happen with our company. Again, control, grab the worksheet, transfer it, and now we can go to transaction 5 and transaction 6. And let's go. We have to clear those one, and now let's go and see what's happened with those 2. Stop sharing this, moving to the slides. Check what's happened. Transaction number 5. Transaction number 5. The company purchased 1-year insurance policy for $1,800. Click on the whole thing, copy it, and let's move to the Excel spreadsheet. Now let's think for a second. We purchase insurance today, but that insurance is for 1 year. Have we used the insurance yet? The answer is no. When we gonna use the insurance? When the time pass. Did the time pass yet? No, it hasn't. So is this for what is this for us? Is it expense? Not yet. Why? Because again, the time hasn't passed. If we decide to change our mind and say, you know what, we made a mistake. We don't need that insurance. We're gonna get our money back. So yes, we pay cash, but is that expense for us? At this point, not yet. When it's gonna become expense? Again, when the time pass. After 1 year, we're gonna have $1,800 expense. How much expense we're gonna have after 6 months? Well, half of the money. $900 will be our expense. How about at the end of the first month? What we have to do? We have to simply divide 1,800, 12 months. 12 months, and every month we're gonna have $150 expense. So since we haven't used the insurance, we just purchased the insurance and we start working, for us in the very beginning, that will be the prepaid expense. Once the time start passing, then we can transfer from that prepaid expense into the expense, the portion of the expense which is related to that month that already passed. Does that make sense?
Yes.
Yes,
So in the
Professor.
beginning, we're gonna
Yes,
have prepaid
Professor.
expense. Great, awesome. So what we're gonna do, when we purchase the insurance, we're gonna have one
Yes,
asset, which is
Professor.
called prepaid expense, and we're gonna pay cash $1,800. So now what's gonna happen? One asset is gonna go down, cash gonna go down. Another asset is gonna go up, prepaid expense. No liability, no equity. We are in balance, and we can move on to the next transaction. For the next transaction, obviously we need the slides. Let's get the slides and see what's happened in the slides for the next transaction. Transaction number 6. Again, copy the entire sheet and let's move to Excel spreadsheet. Paste it as a picture, make it a little bit smaller to fit the screen. And now what we have, company purchased land for $180,000. First, let's think about it. Is the company has cash to purchase that land? Yes, company has $282,100 cash. So can the company purchase land for $180,000? Absolutely. So let's do it. 6. What we got? Once we purchase the land, now we have the land. How much we pay for that land? We pay $180,000. So the land worth $180,000. Now we have land for $180,000, but what we don't have cash. Why? Because we paid cash. So the cash has to decrease with the same amount, $180,000. Those two transactions affect only the asset side. There's no liability because we pay for the land. There's nothing related to the equity. So what's happened now? What's happened with our assets? Did they change? No. The total assets still the same. They just move from one asset to another asset. Before this transaction, watch this. Before this transaction, our assets is $348,900. But we have cash, we don't have land. After the transaction, now our cash going down, but now we have a land. So the total assets are still the same. We're just moving one asset to another asset. Let's keep going and see what's going to happen with the next two transactions. For the next two transactions, what we need to do beforehand, we have to control, drag this worksheet, and now we're going to go to transaction 7 and transaction 8. We're going to delete those two pictures and we're going to move to the slides to grab the next transaction from the slides. Number 7. Let's copy it and go back. Paste it again as a picture, make it smaller here, and now transaction company purchase $23,000 of inventory on account. So let's think about it here. Okay, did we get something? Yes, we get. What we get? We get inventory. We have now $23,000 of worth inventory. Did we pay for it? No, we didn't. Why? Because we purchased it on account. Do you understand this logic? Every time when somebody says, put it on my account, that means I'm gonna pay later. I'm not paying right now. What is that for us? For us, that's accounts payable. For the other person will be accounts receivable. But we get the inventory, we haven't paid for it, so the cash doesn't go down, but liability goes up. Why? Because now we have to pay. How much we have to pay? $23,000. Is there any effect on the equity side? No, there's no effect on the equity side. Let's put one plus here. So the question is, are we in balance? Yes, we are. One asset goes up, liability goes up. Accounting equation is perfectly in balance. Our total assets are equal to our total liability plus equity. 371,900, 371,900 on both sides. We're perfectly in balance. We can move to the next transaction. Next transaction will be transaction 8. So let's see what's happening here. Let's copy it first. And let's move to the Excel spreadsheet. So in this transaction, what happened is we sold products to the customers for $34,000. $21,000 of those 34 we received cash. The balance went to the customer's account. From that sale for $34,000, whenever we sold it, cost us $17,000. So let's think about it for a second. in order to sell something, you have to buy it, correct? You cannot sell something that you don't have. Make sense?
Yes.
So what we're gonna sell? Obviously, we're gonna sell inventory. There's nothing else to sell. In our company so far, we're not gonna sell prepaid expenses because that's insurance which we're gonna use. We cannot sell the equipment because we need that equipment to work with. We're not gonna sell the land because the land is land, right? We're not selling $34,000 land. So what we're selling? We're selling the inventory. Did we buy this inventory? Yes, we did. So that inventory come with the cost, correct?
Yes.
So once I sell that inventory, what I have to make sure I'm selling it more than the cost. So this company now, they selling inventory, which original cost was $17,000. And they're selling it for $34,000. Do they make money?
Yes.
Yes.
Okay, no questions about it, they make money. So let's record it now. So obviously we're going to have two transactions here, right? One transaction we're going to record the sale. The other transaction we're going to show the reduction of our inventory because once we sell the inventory, we don't have it anymore, correct?
Yes.
So in one side, we have to increase our cash because somebody pays $34,000, not always, not the entire $34,000, but somebody is going to pay us $34,000, which is asset for us, and revenue. And in the other side, we're going to have to reduce our inventory and we have to show our cost for the goods that we just sold. So let's do it. First one, let's get the sale. 8A will be this to record the sale. So we're selling, correct? Finally, we're selling. What's that for us? That's our revenue, correct? Make sense?
Yes, sir.
That's clearly revenue. And we're getting how much revenue? $34,000 revenue. Finally, we're making some money. Did we receive the entire $34,000? No, we haven't. How much we received? We received $21,000 cash. How about the other? What's the rest? How much is the rest? 34 minus 21?
13,000.
$13,000. $13,000, we're going to put it on the customer's account. So that means will be accounts receivable for us. Make sense? So $13,000. Now we have to receive those. So now what we have on the asset side, we have $34,000. No liability, no equity, but we have a revenue, which revenue eventually is going to increase the equity section. Now, the second transaction that we have to do is at this point, as you can see, at this point, we recorded the revenue. We're increasing our cash, we're increasing accounts receivables because the customer didn't pay partially. But we still have the inventory. On our records, we still have the inventory. Physically, do we have the inventory? No, we don't. Why? Because now the customer has it. So what we have to do? I have to decrease my inventory. Let's go and decrease the inventory first. AB. The second portion will be decrease the inventory. How much was the cost of the products that I just sold?
17,000.
17,000.
70,000. So that inventory is gone. So I have to reduce my inventory with $17,000 because I don't have it anymore. But that was my cost for the products that I just sold. So that will be my cost of goods sold, which will be expense minus $17,000. At this point, I can clearly see how much I'm generating only from the sales of this particular inventory. I'm generating $17,000 profit. Make sense?
Yes,
Yes.
sir.
Yes,
Okay.
Professor.
Excellent. So that will be the transaction first part. Let me grab from the slides the second part. And I'm gonna post it here for you. This is the second part of the transaction, which shows the reduction of the inventory and cost of goods sold, which cost of goods sold obviously is gonna reduce the retained earnings. But for now, we're not gonna show that one. We're gonna keep it here on the side separately so we can see from our operation at the end of all the transactions, did we generate income or we not haven't generated income? If we generate income, we're gonna flip it to the retained earnings. If we haven't generated income, we also is gonna flip it to retained earnings if we're losing money. Because again, the owner gets everything. He get the profit, he get the loss. That's the beauty to be an owner. You get everything. So let's move to the next transactions. Transaction 9 and transaction 10. Again, control, grab the worksheet, move it, change the numbers here, 9 and 10, and let's see what's waiting for us for those transactions 9 and 10. Let's clear those pictures here first. And let's go move to the slides. Do you guys see my sharing?
No, sir, I'm
No,
not
sir.
able to see your.
How about now?
Yes,
Yes.
sir.
Okay, let's stop this sharing and let's move to the other one. Let me show you what I did with the Excel spreadsheet because probably you missed the Excel spreadsheet, have you? So this is how the previous Excel spreadsheet should look like. 7, 8. Transaction 7, transaction 8, transaction 8A and 8B, part 1 and part 2. And after that, let me delete this one and let's do it together. Delete this one. After that, we're grabbing control, worksheet, moving to the next one, doing here 9 and here 10. Delete those pictures. And now we are ready for the next two transactions, which will be 9 and 10. I think that's where I lost you. So let's go back to the slides now and pull out those transactions 9 and 10. See what's happened there. Transaction 9. Let's flip it back to the Excel spreadsheet and analyze transaction and see what we have to do. In transaction 9, company receive $11,000 from the customers for the sale made on the account. So that will be number 9. Let's think about first. Do we have to collect money from the customers? Is there a customer that owes us money?
Professor,
Yeah.
your screen is not visible right now.
Yeah, someone else have shared their own
Sharing?
screen,
Okay.
so your screen is not visible.
Okay, let me share my screen again. Like this. Can you see it now?
Yes, sir.
Yes.
Yes,
Thank you.
Professor.
Yes,
Awesome.
Professor.
So, transaction says, company receive $11,000 payment from the customer for sales made on account. Do we have money to receive?
Yes,
Yes. How much we have to receive?
13,000.
$13,000.
Right.
Did we receive everything?
No,
No.
No, sir.
We
It's
receive only 11. Let's get it.
11,000.
So once we receive the 11,000, what's going to happen? Cash is going to go up with 11,000, correct?
Yes.
Correct.
And the receivable is going to go down with 11. One asset increase, the other asset increase. There's no effect on the liability, no effect on the equity, no revenue, no expenses, nothing. Let's check how we're doing on total equation. Assets, we have now assets of $388,900. We have 123,000 liability, and we have equity of 265,900. Are we in balance? Yes, we are. Now, what's happened with our equity? Common shares are common shares, but we have increase in equity. Why? Because of the operations. How much is our increase? It's not 17,000, it's only 15,900. Why? Because we're generating 17,000 from the sales of the inventory, but we pay the rent. Remember, that was our rent here. Let's put it here, rent expense, so we know what is this. For that reason, so far we generating our income, net income is $15,900, which become retained earnings. So our equity is $265,900. Now let's go and check account transaction number 10 and see what's happening in that transaction number 10. And I'm going to go back to the Excel spreadsheet. Let's post it as a picture again, and let's see what's happening here now. Company make a payment to supplier for the inventory previously for the inventory previously purchased on account. So the question here is, did we purchase inventory before?
Yes.
Did we pay for that inventory?
With on account.
no, I am pay.
No, we haven't paid. Now we're paying for that inventory. Do we have accounts payable to pay? Yes, we do.
Yes.
How much we have accounts payable to pay?
23,000.
23,000. Did we pay everything?
No. It's
No.
only
Oh,
13,500.
so let's pay the 13,500. How are we going to pay them?
Cash.
Cash.
So our cash is going to go down with 13,500, but our accounts payable also going to go down with 13,500.
13,500.
Make sense?
Yeah.
So
Yes.
now,
Yes, Professor.
do we still have to pay $23,000? No. How much left to pay?
9,500.
$9,500. Make sense?
Yes.
Yes.
Okay. So let's again control, flip this worksheet. Let's move to the next one, and let's do transaction number 11 and number 12. Let's delete those pictures first. We don't need those one. And let's move to the slides. 11. Copy this one and let's go to the other one. Back to the Excel and see what do we have to do here. So, company paid monthly utility cost. What will be that? Most likely electricity, right? So, how much we paid? $1,900. Did we pay it on account? Is it on account? No, it's not. So we pay effectively cash. So let's reduce our cash first because we pay $1,900. Since we paid it, that's not liability. It's not an equity because not involved with the shareholders. It's something involved with our normal operation. What will be that? That will be expense, which is going to be in reduction to our revenue. So negative 1,900, and let's put it here, utility expense. And we're done with this.
Yes,
Yes,
Professor.
Professor.
Let's go with the next one. Let's copy this. And let's move to the Excel spreadsheet again. So here, what's happened here? In this transaction we paid for monthly utility cost. Now we paid for the advertising cost. So is it the nature of transaction different from the other one? No, it's pretty much the same. So what we have? We have reduction of our cash by how much?
2,200.
2,200. And that's too much. 22 with 20, that will be proper. No liability because we pay the cash. No equity because there's no owner here, but it's going to affect the owner. Why? Because that's expense. 2,200, and that will be advertising expense. And we're done. Let's move to the next worksheet, which will be for the transaction 13 and transaction 14. Clear those pictures and let's get the new one from the slides. Let's copy this one. Move to the Excel spreadsheet again. And let's analyze transaction and see what we have to do here. Okay, finally we decide to pay to our employee. How are we going to pay the employee? With accounts payable on account, or are we actually going to give them cash?
Cash.
Cash, absolutely, yes. So what's going to happen with our cash? It's going to go up or going to go down?
Go down.
Decrease.
Decrease. With how much? With $2,900 going down. Since we paid our employee, we don't owe them money. And what will be that for us? That will be pure expense.
Yes.
2,900, that will be, how are we going to call it? Wages expense. We paid our employee. What a good owners we are. So let's insert some lines here. Probably we're gonna need them. And let's keep going. We did transaction 1314. Now let's go with the next transaction. That will be transaction 15 and transaction 16, if there's anything like that. Let's stop sharing this and get the transactions from the slides. Now, what we have to do is now we have to show depreciation. Let's get this one first.
Transaction 14 is not done yet.
14? Oh, 13, 14. We did only 14. What we're doing now? 14, 15, right?
13, 14.
13, 14. 20, 13, 13, 14. Okay, let's get this one. We did the wages. Now let's do the dividend. 13, 14. Thank you. Let's get the 14 first. Share this. Yes, we did the 14 first. Okay, what happened here? The owner came and said, hey, pay me dividend. Now, the interesting part with the dividend, we haven't talked about that, but the interesting part with the dividend, they have to be two things happening before we give the owner dividend. First one is we to have retained earnings. So what we have to check? We have to check, is the company actually making money at this point? So what we have to do, we have to see the revenue, where the revenue is, and when the expenses are. So, does the company making money?
Yes.
How much they're making so far?
8,900.
$8,900.
800.
The other thing that we have to check is, do we have cash?
Yes.
Yes.
Yes, we do. So let's give them dividend. 14, transaction 14 is once we give them dividend, what's going to happen? Cash is going to go
It's
down.
gonna reduce. Yeah.
400, cash is going to go down. And retainer owner's equity is going to go down because we pay dividend. Minus 400, that will be the dividend. So sad for the owners, but he wants dividend. So we have to give him a dividend. That's going to increase his retained earnings with $400. Now we can move to the, oh, I didn't do here 14. Dividend amount, well, we did the 14. So let me flip this one then. Let me get rid of this, delete this one. I went too far. Let's rename this 13, 14. 14. And now we can flip to 15, 16. Okay, let's clear those two. And let's see what's happened on transaction 50. Transaction 50, we already saw it. It's about depreciation. Depreciation. So now what the depreciation is? Depreciation is transferring the cost of the asset over the time because we're using the asset to generate revenue. Again, the company doesn't buy assets because just because. The only reason the company buys the asset is to use the asset to generate income. Make sense?
Yes.
Yep.
If that asset doesn't generate me income, I don't need it. And I can get rid of it. But if that asset generates income, since I'm the for-profit organization, which my whole purpose to exist is to generate income, otherwise I cannot exist. So that's mean I'm going to purchase this asset and that asset is going to generate me income. Once the asset generates me income, I have to transfer from the cost of that asset, because I'm using it, as expense. The question is, how can I do that? The very simple way is, I'm going to check the original cost of the asset. How much originally cost me. Then I'm going to try to estimate how much I can sell the asset after I decide to stop using it. And the last thing that I'm going to estimate is for how many years I'm planning to use this asset. Make sense?
Yep.
Yes.
So for that reason, let's copy what we need. We need this formula. Let's go back to the Excel spreadsheet. And I'm going to open completely new worksheet, and I'm going to call it amortization here, or depreciation. Depreciation. Let's call it depreciation for now, and let's flip this one picture here, and we're going to have it here. Why it didn't come? There we go. Now, what we need then, we need the original cost of the asset. Then we need, let's make it bigger. Not that bigger, only this. So bigger. Then I need residual value. Once I get the original cost and residual value, that's gonna give me the amount that I have to depreciate. Make sense? And the last thing that I need is the useful life. So let's go back to the slides and see what else we can get from those slides. So far we have some information, but not the entire information. We know the formula, that's all we know. So let's see here. That will be the slides related to our asset. So we can calculate our depreciation. Let's stop sharing this. And let's go to our Excel spreadsheet. And paste it as a picture now. So now, if we go back to our accounting system here, the question is, do we have the asset that we can use for our operation? We have cash, we have accounts receivable, inventory, which we sold, prepaid expenses, which haven't we used yet, and we have equipment and land. Which one of those assets we can use for our operation? Both of them, right?
Equipment.
Equipment
Right.
and land.
Equipment land. But on the land, there is no depreciation. That's the tricky part with the land. The land, we not never depreciate the land. However, equipment depreciate. Why? Because we're using it. So now, how much cost us that equipment?
$65,000.
$65,000. So in our calculation, what's the original cost of our equipment?
65.
$65,000. $65,000. Let's do some changes here on the values. $65,000. Now, is there any residual value? Now, for that, we have to check the slides. And the slide says, it doesn't say explicitly, it says here that the residual value at the end of the useful life, we can sell the assets for $3,800. So the residual value is $3,800. So how much we have to depreciate? We have to depreciate 6,500 minus 3,800. 61,200. That's how much we have to depreciate. These people come up with the idea that we're going to use this asset for 6 years. Useful life will be 6 years. Now the question is, how much we have to depreciate every single year? Per year, it's going to be 61,200 divided by 6, correct? Divided by 6. That will be our annual depreciation. However, we are at the end of the month of January. Did we use the equipment for the entire year?
No, sir.
No.
For how long we use the equipment?
For a month.
For a month. So how much we have to how much cost we have to transfer from the equipment into the expense for 1 month, correct?
Yes.
So how can we get from the 1 year to the month?
We can
Divided by
divide it with
12.
12.
Months. So how many months we have? We have 12 months.
12
Why do we
months.
have 12 months? Do you know? Do you know why we have 12 months? No?
No.
Because we're on planet Earth. If we change the planet, we're going to have different months. So, depreciation per year is 10,200 divided by 12 months. Depreciation per month will be $850. So our depreciation every month will be $850. So what we have to do now? We have to go to our chart here, paste it as a picture. Oops, doesn't work this way. Because it's already been pasted as a picture. Let's move here and just paste it the way it is. And what we're gonna do in number 15, we're gonna record our expense, negative 850, which will be our depreciation expense. And we're gonna show the decrease in the value of the equipment, negative $850. Now, the equipment is not longer 65, it's $64,800 at value. Why? Because for the once we use it for 1 month, we transfer from that equipment into the expenses, $850. Make sense?
Yes,
Yeah.
Professor.
Yes,
Yes.
sir.
Okay, let's go with the next one.
Yes, Professor.
Great,
Yes, Professor.
excellent. Let's go with the next one. Next one is related to the prepaid expenses. Now, the prepaid expenses is something that, you remember the insurance. We pay it in the beginning of the January. But let's go back to we don't need this one. I know what we're gonna do here. Let's go back to the slides and let's think about the prepaid expenses. Now, the prepaid expenses, we paid for the insurance $1,800. Remember? That was
Yes.
transaction number 5 here. We paid for the 1-year insurance policy. Now, we are at the end of the first month. Did we use some of the policy? On some, so at the end of the month, did we use the insurance?
Yes.
Yes.
For how much? For what period of time?
A month.
A month. So how much will be per month? If 1,800 is for per year, how much will be per month?
150.
That will be this amount divided by 12. That will be per month. So what we have to do? We have to transfer from the prepaid expense into the expense $150. Make sense? So let's do this. So our prepaid expense is gonna go down
Yes.
with $150, and our actual expense is gonna go up with $150, and that will be our insurance expense. Make sense?
Yes.
Awesome. Now let's go to the slides and see what else left. Is there anything left for us? We did the 16, which is 150. We transferred from the prepaid insurance into the actual insurance expense. And the last one left is the expense related to transaction 17 that I recognize in the income statement the period which they incurred, prior period which they paid in cash. So what's happened here is we borrow money from the bank, correct?
Yes.
Correct.
Did we use those money?
Yeah.
Yes. For how long we use the money?
A month.
A month. Did we pay interest?
Yes.
It doesn't say, right? It doesn't say that we paid interest. But the question is, do we owe interest?
Yes.
Yes.
Yeah. So now the simple logic is this. If you owe something, you have to show it that you owe it. Regardless, have you paid or not. So in this case, the bank asked us to pay 6% annual interest, which transferred to $6,000 per year, correct?
Yes, Professor.
Right. Since the first month already passed, January passed, do we owe the bank interest?
Yes.
Yes. Have we paid that interest? No.
No.
Do we have to pay that interest?
Yes.
Yes.
Yes. So we have to show it as a payable. Let's go and show it as a payable. Now our interest payable is going to go with $500 because that's how much is the interest per month. 6,000 divided by 12, it's going to give you 500 per month. So liability is going to go up. There's no asset here. Asset is not involved. What else is going to hit us? It's going to hit us on the expenses, minus 500, and that will be interest expense. Make sense?
Yes.
Awesome. And we're done. So now let's see what we have here. After we done all the transactions, what's left for us? We have cash, we still have receivables, we have inventory left, we have prepaid expenses, that's for the insurance for the rest of the year, we have equipment, and we have a land. In total, we have $367,000 of assets. We paid some of our payables, but we still have to pay $9,500. Plus, now we have to pay interest to the bank, $500, and we have to pay the whole principal, $100,000. So that's $110,000 we have to pay. We have common shares, and we generating 34,000 revenue, and we have expenses for, let me see exactly, for $9,600. We have a dividend for $100 that we paid. So in total, we have increase in retained earnings with $7,000. Are we in balance? Yes, we are. Because $367,000 assets is equal to 110,000 liability and 257 equity. Which are the statements that we have to prepare? First, we have to prepare statement, income statement. On the income statement, what we're going to have? Now I can make it bigger here so you can see it. Income statement. On the income statement, obviously, we're going to have the company name, statement of income for the period. Ending January 31st. Correct? And then we're going to have revenue. How much was our revenue? 34,000. Then we're going to have expenses. If we have to do it properly, it has to be cost of goods sold. Our cost of goods sold are exactly $70,000. Let's on the income statement, there's no negative amounts, so $70,000. Then we're going to have a gross margin. How much we're generating from selling only the products. Our gross margin here will be 34 minus 17. Then we're going to have operating expenses, which operating expenses will be, let's move those one from here, right here. Operating expenses will be equal to negative bracket this plus utility plus advertising plus wages plus depreciation plus insurance expenses plus interest expense. $9,600 operating expenses, and our net income is equal to $7,400. Since we've done the income statement, the next thing that we have to do is statement of owner's equity for the same period, for the period ending January 31st. The statement of owner's equity, we're going to start with the beginning balance of January 1st. How much was our beginning balance of the owner's equity of January 1st? Before the company started. It was zero, correct? There was nothing. Then the owner made the contribution. Makes sense? Then we issue the common shares or contribution. The owners made the contribution of $250,000. Next thing that happened is company generating net income. How much was the net income? $7,400. And the company distributed dividend of
$400.
$400. So where is the owner's equity at the end of the period? Ending balance at January 31st. $257,000 owner's equity. And we're done. The last statement that we have to prepare is the balance sheet. So on the balance sheet, we have to show what the balance sheet is at the period of time. So that will be at January 31st, year, some year. So what we need to have here, we have to have assets. And we're going to list the assets the way they are. Cash, accounts receivable, inventory, prepaid expenses, land. I'm going to copy those one and I'm going to paste it like this. So I have my assets. So assets are equal to that one. Let's make it smaller, those ones, so you can see the numbers. Then I have, no, that's the opposite. So that will be the cash starting from here. My cash is 13,200, accounts receivable 2,000. Then I have, let's copy those one like this, the same way I copied the other one and post it like a number, but as like this. No, it doesn't work, does it? Let's do it old-fashioned way. Equal to this one, equal to that one, equal to this one, and equal to that one. So I have total assets of $367,000. That's my all total assets. Then I'm going to have a liabilities, and then I'm going to have here liabilities. My liabilities will be all those three, which I'm going to paste it like this. Accounts payable, interest payable, and bank loan. That will be equal to this amount, equal to that amount, and equal to this amount. My total liability in this case will be all those three together. And the last thing that left is the owner's equity, which owner's equity, I'm going to get it directly from the statement of owner's equity, $257,000. And then I'm going to have, after that, I'm going to have my total liability and owner's equity. It's going to be simply 110 plus 257, $367,000. Now I have to be in balance with my total assets, which I am, and my accounting for this company is done with all the statements which are related to my account. So this is the order of the statements. First, we start with the income statement, because the net income is the one that flows from here into statement of owner's equity. This is the link between the statements. Net income from the income statement move to the statement of equity. Once you get the statement of equity, then you're using the final balance to get that owner's equity. Make sense?
Yes,
Yes.
Yes,
Professor.
sir.
Yeah.
That's how easy and simple accounting is. So now let's go to the slides and finish with those slides. Again, if we continue with the slides that we're going to see, which we already have it, and equation template, now we have it. The statement of the, we have to prepare a statement of the income, changes of equity, financial position, cash flow. We're not going to spend time on the cash flow, so don't worry. So the statement of income calculates the profit. Those dividends are not part of the statement of income, that's why excluded. So what we're going to do here, you're going to see this sales revenue, cost of goods sold, the way we did it, gross profit, and after that, starting the operating expenses. You can list it by nature, or you can just put it operating expenses. And as you can see, the net income, 7,400. Then we're moving to the statement of owner's equity, which start with balance 0. Then we have issuance of the common shares, $250,000. Net income, 7,400, and 400 retain. That's reduce dividend, reducing the retained earnings. Total balance at the end of the period, $257,000. After that, we preparing that classified statement of financial position, aka balance sheet. On the balance sheet now, we can group the assets on the current and non-current, finish with the total, and then we have the liability and equity, directly equity. You can split the shareholders' equity to common shares and retained earnings. You can show the directly equity section and the total liability and equity, and we're done. The cash flow statement, again, we're not going to spend time on this because that's a different ball game. It's heavy stuff. So it has three sections: operating activity, investing activity, financing activity. In operating activity, we're going to see how much cash we're generating from our main operation. If the company doesn't generate cash from the main operation, that means that company has trouble. Then we're going to move to the investing and financing sections. And then we're going to give us the cash balance at the end of the period. Now, ratios. The first ratio is the profit margin ratio, which is the net income divided by sales revenue. Net income, which is our total sales, $34,000. Once you see the statement of income, sales revenue is always 100%. Always 100%. Then we see out of those 100%, how much left to us. So basically, the first ratio, which is here, the profit margin ratio, tells you from the $34,000, how much left in the company after you pay all the expenses. And you can see what's left is 21%, almost 22%. What that means, for every dollar of sales, 21.8 cents stays in the company. Then we're going to get another ratio, which is the return on equity. Since our equity, as we saw here, is the total equity is 250, which the owner invested, and 7,000 that was earned to the period. How much is our return on the equity? For every dollar that you invest, you're getting 3 cents. Now, return on the asset. From the total assets that you have, how much income you were able to generate? You're generating only 2% of the 2% return on the assets. So what that means? That means to you is this: if you're only borrowing money, follow me here. Let's say the only assets that you have is because you borrow cash from the bank. And if you pay 6%, the way they're paying 6% interest to the bank, and you're generating return only 2%, you're in trouble. Because you're not generating enough to pay the interest to the bank. So if the only source of assets that you have is borrowing, at least make sure that the return on assets is more than the cost of the borrowing. But that will be on the finance course. You're going to deal with the finance course on that one. And that's complete the chapter 2. Now, the other thing that I wanted to discuss with you is some questions from your assignment. Let me see, is there any tricky here? Multiple practice question. That's multiple choice question. Let's see, practice question. Wiley, financial, accounting, that's easy. That should be okay with your question 8. Let's see question 9. Question 9. Question 9 ask you for which statement some things gonna belong to. That should be fairly easy. I don't expect you to have problem with that. And the last question is again, income tax payable, which statement belong, cost of goods sold, to which statement belong, property, plant, equipment, which statement they belong. So what I would suggest you to do is go over the slides. You have the answers in the slides, so you don't have to worry too much. You should be okay with the first assignment in Wiley. I don't see anything scary there, honestly. The last thing that will left for you is you to check the activity. I know you have some activity you have to do on the bright space on weekly discussion. On the weekly discussion, please post at least once of this week assignment. You're highly encouraged to ask your fellow to add what's the sum. Week one discussion. On the week one discussion one, you have to constructive part discussion rather than the incentives. So there's some interesting financial accounting concepts come up with week one. And what are some of the challenges? Creating statement of income. So I want you to post something. Some of you already did. I want all of you to make those postings because again, I'm going to use those postings to evaluate and give you those 5% that's left for you. The last thing that I want you to do is I'm going to create here very quick one new discussion. And under that discussion, I want you to tell me, it's not going to be graded, anything like that. That's more for me, is I want you to tell me, how do you feel after the first two lectures? We already did 2 lectures. And the other thing is, I want you to tell me, how do you like the style of teaching? And any suggestions? And you're going to have it at the very, very, very bottom. Let me see where exactly it's going to be. It's going to be on the very, very, very bottom, I believe. Discussion after class. Yes, before your week assignment. So let me show you where exactly you can see it. It's right here. So once you go in the content on week one, once you scroll down, discussion after the class. Dear students, how do you feel about the first 2 lectures? I have to change the spelling and how do you like the style of teaching? That's what I want you. First 2 lectures, how do you like the style of teaching, and any suggestions if you may have. So what you have to do is just go to here and do one posting. It's not for marks, it's just for me to get the feedback for you. How do you feel? And that will be all.
Thank you so much.
Thank you, guys.